Hey everybody, Chuck Gibson from Financial Perspectives with my monthly market recap for August 2015. All I can say is what a month, and I'm glad it's over. My first chart is just a little humor. It's about all you can do after we went through last month. August had the S&P 500 moving up or down at least 1% for 6 days in a row. It was early April 2009 the last time we saw that. The record, though, is a whopping 23 days in a row, which happened in the Great Depression in late 1931. On the flip side, the S&P 500 was up more than 6.4% Wednesday and Thursday alone of last week, which was the best two-day rally since March of 2009. Best ever was set back again in the Great Depression in 1933, and it rose a bit more than 20%. If the usually boring August turned out as it did, I'm not looking forward to what a historically more volatile September and October may have in store. In times like this, it's best spent focusing on the broader index for clues, because until they can find traction, it will be difficult for the rest of the market to do something different. My first real chart is that of the global indexes. The MSCI World Index is on top, followed by the S&P 500, the German DAX, the Japanese Nikkei, and the China H shares are at the bottom. As you can see, all are in the middle of a correction, and most reside slightly above their weekly long-term uptrend lines, which still support their longer-term bullish view. China, the lone exception, has broken below. My next chart is that of the China Shanghai stock market. The difference between this and the H shares from the prior chart is the H shares are those Chinese companies that are traded on the Hong Kong exchange quoted in Hong Kong dollars. This chart is that of the Shanghai Stock Exchange and is not directly open to foreign investors. I wanted to show this chart as it better reflects the wild volatility of late and has the world market spooked. The Hong Kong shares look much tamer in comparison. You can see the Shanghai market rose almost parabolically, climbing 160% over a short 8-month period. It has wiped out almost 40% of that gain in less than a month. Notice, this is the second time China's market blew a bubble and then popped, as the first one occurred from the 2005 to 2008 timeframe. These are great examples of human emotions and actions, and not strategic investing. The smart money gets in at the bottom and out at the top, and the late-to-the-party bag holders just get creamed. My view is if the ruling party were to not intervene in their markets, the current move still has more downside. If that turns out to be true, we are in for a very tumultuous time across all markets until there stabilizes. In my next monthly chart of the CRB commodity basket, you can see it bounced off long-term support and formed a bullish hammer candle, which is the sign of a potential reversal. That combined with the bullish RSI divergence tells us to be aware of the potential for a bounce. After a 60% correction, it's about time this thing finds some traction. The recent move higher in this index was triggered mostly from the rebound in oil, as prices soared more than 30% from their most recent lows, its biggest percentage gain in 6 years. Oil, like other commodity markets, are small, volume is thin, and controlled by a few really big players. So unless you're either on their email lists, it can be really hard to capitalize, except in long-term trends. In addition, it's not unusual to see prices be pushed well beyond fundamental reasoning. When that occurs, it can create a very compelling long-term profitable investment thesis. In my next chart of a weekly look at the S&P 500, price has broken its most recent intermediate-term uptrend line, and while it's hard to see, it has also signaled a bearish death cross. On the positive side, last week printed a hammer candlestick, which requires follow-through confirmation to be valid. But if we get that this week, it signals a bottom and a potential price reversal. I am watching this closely for my cue. In my next chart of a shorter time frame daily look of the S&P 500, you can see the 11-month rounded top that formed and eventually gave way on the 18th. That created a quick flush down and just as quick reversal, which has retraced almost 50% of the down move. I have added in black the 3 major support resistance lines here, here, and here. The death cross is more visible on this chart as the red 50-day line has crossed under the purple 200-day line. I have spent countless hours going over scenarios on how I think this correction will play out. I thought it'd be worth sharing those with you on my next chart of the S&P. The first option is a V bottom like we experienced in October of last year here. While this is a possibility, I put this as the least likely of all scenarios for a couple of key reasons. First off, notice how the 50-day moving average is above the 200-day moving average, and the 200-day moving average is pointing up. That is not the case this time. Not only has the 50-day just crossed under the 200-day, but the 200-day is now pointing down. Secondly, notice when you look to the left of the October low, price moved quickly higher because the amount of overhead supply was relatively small. That is in contrast to the situation right now, as you have this 11 months worth that buyers will have to absorb if prices to move higher. That creates massive resistance. Of the next two scenarios, one is bullish and the other is bearish. Let's talk about the bullish one first. This gray shaded area is the 50 to 61.8 retracement of the decline. This area is a magnet for bounces off corrections. This is where I expect price to consolidate as the bulls and bears wrestle for final control. My bullish scenario is we will likely see price consolidate up and down for a few weeks, but the bulls ultimately win the battle and prices move on to new highs. Higher is good, but I doubt it will be a smooth ride. Probably choppy like what we've experienced over the past 9 months, but instead with an upward bias. My third and final scenario is we consolidate in the same area, the bears win the fight, and prices reverse lower. As mentioned in last week's blog post, I view last week's decline as the A leg of an ABC correction. And if that's correct, we have further to go on the downside. The first target is last October's 1835 low. And if you haven't noticed, corrections move much faster and violent than the climb up and usually overshoot their targets to the downside. If the October lows don't hold, then the next target is 100 points down at around 1735. While this is the scenario I favor most at this point, it appears as I scan other technicians, I find that a bulk of the technical community is in agreement with me. If my conclusion about the community is true, then it likely won't happen because when everybody thinks something will happen, it doesn't. It's like when the boat is too crowded on one side, it's usually best to become a contrarian and move to the other side. Corrections are not fun to go through because everyone loses money. The purpose of a bear market is to destroy capital and shake the weak hands of their investments at discount prices. I'm not trying to minimize the significance of a correction because some corrections turn into bona fide bear markets. And if you're in a bear market, you should get out. But if it's only a correction, it's time to consider adding to your portfolio. Most everyone is closing out the month of August with a whole lot of cash. So if this eventually becomes a buying opportunity, we have lots of dry powder to take advantage. In advance of what we think will eventually be higher prices, we have put together a shopping list of our favorite companies and at prices we would consider stealing, just in case the opportunity emerges. You're probably asking, how do you tell the difference between a correction and a bear market? Firstly, look to the economy for a clue. Recessions are one of the hallmarks of what one needs to be in place for bears to come out of hibernation, and we're nowhere near a recession. The second place to look is the credit markets, as they are the elephant in the room. Right now, a disaster scenario, where the credit markets collapse due to a lack of liquidity, just isn't happening. In fact, high-grade credit isn't acting all that bad, and I don't see any major changes in the default rate. Additionally, junk bonds, while moving down on with other risk assets, are still looking fine. So until any of these change, I see this as a normal overdue correction. Of course, like everything, it's dynamic and can change very quickly, so we watch, wait, and stalk the markets. Looking at the two generational bear markets over the last 20 years, we see the dot-com bust and the global financial crisis, lovingly referred to as the Great Recession. Two generational bear markets in a 10-year span. In one case, we had the biggest stock market bubble ever, and in the other, the biggest housing debt crisis ever. Both good reasons for a bear market. If this is not a bear market, then you're likely wondering, what are we selling off for? There's never just one reason, but much of the concern and focus is on what's happening in China. After a decade of ridiculous overinvestment, it is possible that they're on the cusp of a very serious recession, whether they want to admit it or not. But the good news is their currency is strong and it can weaken a lot. And their interest rates are high and they can come down a lot. China has a lot of policy tools it can use, unlike here in the US. Let's quickly take a look at the biggest and baddest corrections, not bear markets, over the last 20 years. In 1997, we have the Asian financial crisis. In 1998, we had Russia in the long-term capital management crisis. In 2001, we of course had 9/11, and in 2011, we had Greece. In retrospect, these crises look kind of silly, even junior varsity, even though they were all between 20 and 25% losses and miserable to live through. Mark Douglas in The Disciplined Trader wrote, "In the market, the fear of losing one's fortune is every bit as intense as the fear of losing one's life from an attack by a wild animal. I don't think I could put the difference between consistent winners and everyone else more simply than this. The best investors aren't afraid." Kudos to all of those who have handled this current bout of volatility with such maturity and professionalism. Most everyone expressed their displeasure on what was going on, but stated they were not worried. Only a tiny fraction vocalized wanting to jump ship. Corrections are not the end of the world. This is not a time to be afraid, but rather be bold. And I view corrections as great money-making opportunities, and that's the goal here, right? Sometimes it may be hard to remember, especially during times like this, that you cannot make money without risking it. You have probably heard professional investors warn about trading with scared money. The reason why is scared money never grows. That's it for this month's video. Have a great September, everybody, and buckle your seatbelts. As always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with the August monthly market recap.